I now hand the conference over to Mr. Siddharth Mundra, Chief Executive Officer. Thank you, and over to you, sir.
Thank you. Good morning, ladies and gentlemen, and a very warm welcome to all of you. I hope all of you are keeping safe and healthy. Today, I'm joined by Mr. Sukumar Srinivas, Managing Director, Mr. Alex Varghese, Chief Financial Officer, and Strategic Growth Advisors, our Investor Relation Advisors. We have uploaded our updated result presentation on the exchanges, and I hope everybody had an opportunity to go through the same. Let me begin with broad highlights on our second quarter performance. We have had a definite turnaround in our performance in the second quarter as compared to the first quarter. We recorded a profit of 6.25 crores in the second quarter as compared to a loss of 25 crores in the first. Our month-on-month revenues as a percentage of last year's revenues have also reached 82% levels as in September. In line with our focus on the balance sheet, we recorded strong operating cash flows of 61 crores in the first half. Our debtor levels have also reduced by 172 crores and inventory by 108 crores. Let me now take you to the current scenario and the demand outlook. This quarter observed improvement in sales on a sequential basis as the markets opened up with the unlocking of the economy. The demand recovery was seen across all segments. Tier 2 and 3 cities demand is nearing normal on the back of good monsoon season. There is pickup seen in construction activities and also in the automobile industry. For the months of July, August and September, we have been able to achieve 71%, 79% and 82% of our sales as compared to the same figures achieved in the last year. On the retail side, we are seeing some pickup in construction activity. Also, individual home builders are making use of historically low interest rates. Various cost optimization and cost control measures have been adopted internally to control the cost and preserve capital. This has yielded positive results for the quarter and will also be visible in the coming quarters. Our EBITDA margins for the quarter were at similar levels to those in the same quarter last year. Let me take you to the financial highlights for the quarter. On the revenue front, our Q2FY21 revenue stood at 488 crores and recorded a sequential growth of 41%. The quarter revenue stood at around 77% of the levels achieved in the last year. For the first half FY21, revenue share from retail stood at 59%, channel revenue stood at 23%, and enterprise revenue stood at 18%. As we mentioned, we have observed a good demand uptick from Tier 2 and Tier 3 cities, and they have achieved normalcy. On the EBITDA front, the Q2 FY21 EBITDA stood at 20 crores versus a loss of 9.3 crores in the first quarter. With various cost reduction initiatives, our EBITDA margins are nearing normalcy at the same levels of the last year. This is despite lower contribution from the enterprise business, we have been able to sustain our EBITDA margins. On the PAT front, the Q2 FY21 PAT stood at 6 crores versus 10 crores in Q2 FY20. On a QOQ basis, there was a turnaround from a net loss to a net profit for the quarter. Our overall net debt and acceptances have reduced by 14% and stood at rupees 292 crores as of end of September as compared to end of March. We have also ensured timely payment for all our banking commitments and all our trade creditors. Now let us focus on the segmental performance of the company. Please note that the first half performance is not comparable to the last year's first half performance due to shutdown in operations because of the pandemic. On the retail segment, the retail sales for first half stood at 492 crores. Our focus continues to grow our retail sales with higher throughput from our existing stores. We are also pushing our sales through the digital and omni-channel presence. As on 30th of September, we had 115 stores under the brand name Shankara Build Pro. Average rental cost for leased outlets stood at 15.9 rupees per square foot per month as compared to 20 rupees for the same quarter last year. The total area stood at 5.2 lakh square feet with an average store size of 4,500 square feet. Average ticket size per transaction was around 30,600 rupees for the second quarter. Channel and enterprise sales for the first half stood at 342 crores. It overall contributed around 41% of the consolidated revenues of the company. The channel business has held on steady during this period and there has been a gradual recovery on the enterprise side over the last couple of quarters. We continue to adopt a partial wait and watch policy while taking adequate measures to ensure operations run in a smooth manner. With this, I open the floor for discussion.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The first question is from the line of Siddharth Rajpurohit from GHP Securities. Please go ahead.
Good morning, sir, and thank you for the opportunity. Sir, my first question is, sir, we have done a very good job on the working capital side, sir, and there is a significant reduction in the inventory and debtor days. If we see from Q1 to Q2, debtor days have further been reduced, whereas inventory has come back to some level with the increase in the business. So how do you see the sustainability of the working capital at these levels as we go more and more towards normal?
So as you rightly mentioned, so there has been a lot of effort that has gone on, especially on the debtors side. The debtor days, so the debtors in absolute numbers as well as in terms of number of days has reduced, sequentially as well as year on year. The inventory is also substantially under control. So we will continue on these measures, and we look forward to an improvement in the coming quarters as well.
Okay. But will the like how the inventory has come back, so that you're guiding for the improvement on absolute terms, further improvement in the debtor and inventory levels?
That's right.
Okay. The second question is, if we compare, sir, the recent quarter results where the OEMs like the bars or those manufacturers like APL Apollo or ceramic manufacturers like Kajaria or Asian Paints and all those players are able to give some volume growth or almost equal to last quarter, whereas we are still down, say 20%. And so what do you say, sir? What the reason is? Lack of demand or the cost-cutting measures that we have taken that has reduced some aggression in the employees? They are not that motivated or not that aggressive. What are the reasons, sir?
So just in terms of a data point, if you look at sequentially, our revenues have been tracking up. So we are at 82% levels as compared in September, and in October we are further higher up at around 85-86%. So we are also gradually and slowly shrinking up, and we feel that over the course of the year we will be able to get back to our last year levels.
Okay, so the constraint is demand in the region, sir. We are almost motivated. The team is motivated to reach the maximum, the optimum level.
I don't think there's any problem with the team, because the primary reason is also that in certain areas, because we also have 50% of our business comes from the enterprise and the channel business, which have only started picking up. Particularly the enterprise, that is the industrial and the OE business, has only started picking up from September onward, realistically on the ground. So I think that is an area which it is picking up. Number two, we also want to curtail credit. So overall, I think the actual liquidity on the ground has certainly improved over the last the last few months. But we are still, certainly as Siddharth said in his opening remarks, we are still keeping a fairly cautious watch and wait approach to the coming months.
Okay. So don't you see, sir, given the demand revival, that the caution, some probability of reduction in caution and more focus on growth?
Yes, that is what we have now come to around 85%. And as Siddharth said, we will be reaching the normalcy towards the third of the fourth quarter.
Okay. So if we see year-over-year our numbers, it is better than what is currently seen because we are 15 stores less. So if we take 3 stores, 3 crores sales a store, that they are already 40-45 crores sales is not there. So if we report same store sales growth, it would give us more better picture, sir. If you can do that for next quarter, it will be helpful, sir.
Yes, so I think right now, unfortunately, the environment is such that the same store sales growth will not make a lot of sense. So as things normalize, we'll start reporting that.
Okay. And sir, when we have actually increased the pace of store reduction, where we have already closed, I think, 8 stores in this Q3 last month and 5 stores in Q1. So, how do you see, sir, this the aggressive store reduction that we are doing? So, what are the key factors for that, sir? The demand in those regions is very bad, or we are not able to beat the competition, or we are not able to replicate our model of hub and spoke model in the store sales. What are the major factors for that, sir?
See, if you look at the approach, what we are largely looking to achieve is maintain our revenue throughput, but with a lower store count. And this is to help us optimize our overall cost structure and ensure that our margin levels continue to stay healthy. And if you look at the overall number of stores that we have closed in the recent past, the overall contribution to the revenues was only 3%. So it was not a meaningful contribution. They were on the margin. And as they had not scaled up meaningfully, we have taken a call in these times.
Okay, sir. And this store reduction will help in higher profit, right? Because those will be loss-making stores.
Right.
Will add to the bottom line. Okay. And when can we see the reversal of the employee salary cut and all that we have taken, sir?
Give us a couple of quarters, we'll get back to you.
Okay, sir. Thank you, sir. I have more questions. I'll come back in the queue, and all the best, sir.
Sure. Thank you.
Thank you. Reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Sachin Shah from SS Securities. Please go ahead.
Hello.
Yeah, hi.
Hi. Good morning. Thank you for taking my question. I just have a couple of queries. First, can you throw some color on capacity utilization for the quarter and as well as for the H1? And how do you foresee for H2? What's your outlook on that?
Capacity utilization at the H1 level for first quarter was pretty bad, but we have scaled down also partially on the capacity. So we can say we were operating around 50% of the capacity for the whole H1 level. Which has currently come in the month of September. It has ramped up to, in one of the 3 manufacturing units, we are at almost around 90% of the capacity utilization. And in one of them, we are still at about 60%. So you can say on an average, we have come back to around 70 in the month of September.
Okay. So you're getting back to the normalized situation in that sense.
Yeah.
My second query is on the retail business. So what's your EBITDA margin for the quarter H1 and how do you foresee for the H2?
Q2 was 6% EBITDA was in Q2, and then with the Q1 it was minus.
Retail business, right?
Yeah.
Okay. 6% for the Q2. Hello? Yeah.
Second quarter, 6%.
Okay. And just can you throw some color on the rental cost? Have you seen any waivers during the last 6 months or so? And what's the sustainable cost? Because I see it's pretty stagnant for the in that sense. What's the sustainable rental cost for company as a whole year?
It is around 16 rupees per square feet. So overall, there was a bargain with the landlord, so we are able to reduce the rental cost.
Yeah, it has come down by about 4 rupees per square feet approximately. So there is a fairly decent cost reduction on the rental side.
Okay, but that seems to be sustainable.
I think it will be sustainable for quarter 3, and we hope that we can push through for the next coming months also.
Okay. Thank you so much. That's it from me. Yeah.
Thank you. The next question is from the line of Maulik Patel from Equirus Securities. Please go ahead.
Thanks for the opportunity. Few questions. Given that your recovery is still around 80-85% level, what kind of full recovery when you can look into it, probably by the end of FY21? And once we have a normalcy, what could be the strategy going forward? And as we discussed in the earlier con call that this year the focus has been on the debt reduction, working capital, and the cost control, given that the things were uncertain. But once we see probably next 3 to 6 months of full recovery, what will be our step going forward? Because then, in terms of retail expansion or the retail profitability, any thoughts on color on that would be really helpful.
So Maulik, so the thought process is on ensuring that our balance sheet as well as the P&L continues to stay healthy. We have, as you would have seen in the second quarter performance, we've already seen some of that coming through, whereby the P&L has also coming back into the black, and the focus on the balance sheet continues. So I think that will be the guiding force for us in the next coming quarters as well. And we're looking at the full year in terms of a good P&L as well as a good balance sheet. So I think the immediate thought process is that to ensure that we achieve this.
And given that the revenue mix, if you look at the channel has done much better compared to the enterprise, which is significantly lower, and the retail has been in between somewhere. Post normalcy, what do you expect the trend, and will it impact the profitability? Any change in mix will impact the profitability?
There could be a bit of an impact, Maulik, because of this, because as you're aware, the channel is a slightly lower margin business as compared to the enterprise. Enterprise was virtually, non-existent in first quarter, and only just started picking up. And we hope that during the course of the year that continues to chug along well. The retail is also holding up, but I think the margins have also come down there in terms of, because the overall revenues have also come down. So I think the change in the mix will have a bit of an impact on the margins. Having said that, our Q2 margin profile was pretty much in line with the margin profile of last year.
Sure. And given that the retail, we have closed a couple of stores in the last 2 years, right, from the and so now currently all the stores are profitable, and are there still some stores probably you can go for to some kind of restructuring in coming quarters?
I mean, there could be a few stores on the margin. I think we're largely done, but there could be a few stores which we may still want to take a call on.
Okay. And what could be the thoughts going forward on non-steel part of the revenue? What percentage of revenue right now is in steel? I think we used to at around 80% kind of that level, around same level, or any change in that? And how is the ramp up in non-steel revenue? And how the customers are accepting post this pandemic?
So see, both sides of the business continue to hold on well. We are necessarily not pushing any specific category right now. So wherever sales are coming through, we are doing that. We are conscious of the overall data position that we hold on our balance sheet. So in that context, I would say that both are getting along quite okay.
Okay. And any change in the customer behavior for the non-steel part of the business? compared to the pre-COVID and the post-COVID?
The only thing is, I would say that they would be possibly a little more circumspect in terms of, looking around, going around.
I think overall, from a retail perspective, the number of walk-ins as such definitely has got impacted a little bit because people are still that comfortable in. So that is where our digital catalog comes into play, where they look into the catalog and then even if they do visit the store practically, it's a quicker turnaround time compared to the past.
I got it. Okay, thank you.
Thank you. The next question is from the line of Riddhima Chandak from Roha Asset Managers. Please go ahead.
Thank you for the opportunity, sir. As you said that walk-ins have declined. So in the quarter one, approximately there was decline of 65 to 70% individual walk-ins decline. So currently, what is the progress on that?
I think it has picked up. Currently, we would say the decline, in terms of a year-on-year comparison, we would still say there is about a 25% down on the walk-in.
Okay. And in terms of breakup, or as we have seen the progress across all our key categories, so which is our major top selling categories in terms of revenue contribution in the retail?
Construction materials will be the largest, which will be contributing almost 65%. Then we have our other categories, which are plumbing and sanitary ware, tiles, electricals, interior exterior products. So they would make up for the balance share. Irrigation as well.
Okay, so as so I just asked that, in the construction, as it is contributed 65%, so how much recovery we have seen from quarter one to quarter two in terms of demand, in terms of sales?
Yeah, around 40%.
Okay. So we have recovered 40% of sales as of now.
Yeah, improved.
Yeah. Okay. And how much conversion we have seen across average conversion across all our stores?
The conversion rates for us has historically also been high. I would say that it would have only inched up higher during this period. So conversion has not been a challenge actually.
Okay. And as tier 2 and tier 3 cities are growing very well for us, so what is our revenue contribution from tier 2 and tier 3 as well as from tier 1?
So tier 1 would be around 35%.
Okay.
Tier 2 would be 26 and tier 3 would be the balance 38.
Okay. So earlier we stated tier 1 down by approximately 51%. So how much recovery in all of the tiers?
Yeah. So the recovery has been broad-based actually. So
it
had fallen more because the tier 1 had fallen more in Q1. The recovery has been that much more stronger. Tier 2 and tier 3 had fallen also lesser. So in that context, the recovery is lesser.
Okay. So as we are also focusing on our omni-channel sales, so what is our revenue contribution as of now and going forward, say in the next 1 to 2 years, what are our goal to reach to a certain level?
So right now, the way the omni-channel works is that we direct a lot of those inquiries and the walk-ins to our stores. So while we can fulfill, it's a complete fulfillment engine also on that we can do on the website. But a lot of our categories do require people to come and physically visit. So that's how we look at this omni-channel approach, where we are saying that a lot of the customers who are visiting us online are actually also eventually going offline, and it's working as a customer acquisition tool for us.
Okay. And just one last question. So on the debtor side, the debtors has reduced significantly during the quarter. That is approx 172 odd crores. So in the channels and enterprises, how much is our debtors as of now out of our total debtors? Hello?
Yeah, we'll just come back to you on that.
Okay. Thank you so much, sir.
Thank you. Reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Siddharth Rajpurohit from JHP Securities. Please go ahead.
Thank you for the opportunity again, sir. Can I have the breakup of construction material, new product, interior, agri?
Yeah. So as I was mentioning, around 65% comes from construction materials. Around 15% comes from plumbing, sanitaryware, and tiles. Another 15% comes from electricals and the interior exterior products, and 5% comes from irrigation.
Okay. So, means retail being a business where working capital is the investment, the debt reduction on quarter would not be the right parameter to see. So do you have any long-term guidance that we have targeted in terms of interest coverage? This would be the interest coverage that you have targeted, or the debt equity that you have targeted for a long run, 2 years down the line?
So we are overall targeting ROC levels of 20% plus. So that is the target that we have. And in terms of debt EBITDA, to hold at that 2.5 or lower.
Okay, debt to EBITDA. Okay. And so, given the current demand situation or the cycle of store expansion and the closure, do you see a uniform format of stores to be an important factor or to play some role in terms of maintaining the channel? Because all our stores have different formations of the placement or the look. So do you see that an important?
So the broad look and feel is something that we try to maintain in terms of the branding, the internal facades, etc. In terms of color combination, also we have made an effort to ensure that that is consistent. The challenge for us many times is that we being a rented retail operation, we also need to purpose our retail store in terms of the premise that we get. So everything need not necessarily be a very squarish or a rectangular or a common kind of a format that we get. We try to ensure that the stores that we take up have a good frontage. They are generally on the ground floor and have good road access. That is the basic thing that we try to ensure in terms of all our stores.
Okay. Because generally there is bifurcation of stores. Means there is people use different kind of bifurcation or nomenclature for their stores. So do we have anything where we can bifurcate our stores that these are premium stores and these are economy stores, or like any breakup?
No, I think right now we're not thinking on those lines.
Okay. But the store format doesn't hinder our channel management?
No, not at all.
Okay. And so, are there any write-offs in H1?
No, there are hardly any write-offs, but there are some provisioning which has been made. Yes.
Okay. What would that amount be, sir?
It will be approximately around 2.2 crores.
Okay. Thank you, sir, and all the best, sir.
Thank you. Reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Rohan Shah from Harsh Capital. Please go ahead.
Hello. Thank you for taking my question. Hi. So I just had a couple of questions. So my first question is that we had guided in the past that we want to strategically curtail operations in the channel business. So my question is that post business coming to normalcy, do we have the same plans of focusing on the retail and degrow our that business, the channel business?
So I think the broad thought process continues. So that we will that broad on a longer term guidance, I think that continues.
Okay. So my second question is that what were the percentage of our own products revenue in Q2 and H1 FY21, and how much does the newer product category contribute now?
25% was our contribution of our own products.
Okay. And how much does the newer product category contribute now?
20-odd%. Yeah.
Okay. Thank you. So that's it from us.
Thank you. As there are no further questions, I would now like to hand the conference over to Mr. Siddharth Mundra for closing comments.
Thank you everyone for joining us. I hope we have been able to answer all your queries. In case you require any further details, you may contact us or our investor relation advisor, Strategic Growth Advisor. Thank you.
Thank you. Ladies and gentlemen, on behalf of Shankara Building Products Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.